Hello everyone, I am Jagannath Kulkarni. In continuous to the previous video, we will going to talk about today on the capital market, and within the capital market, the primary market, which all of us we know as IPO. Let us begin. Previous video, we spoke about the different type of major financial instruments. Continuing that in this video, we will touch upon the capital market with a brief inclination towards the primary market. Capital market is mainly classified into two divisions. One is called primary market and another one is called secondary market. So let us understand the capital market further subdivisions, and like I said, it has got two divisions, primary market and the secondary market. This video is more about the primary market. Let us understand the primary market more in detail, the further subdivisions. The primary market has got a further division like public issue, right issue, bonus issue, private placement. So within the public issue, there are further classification called IPO, that is initial public offer, then FPO, that is called further public offer. And within the private placement, there are further classification which is called about preferential allotment, and then qualified institutional placement and the institutional placement program. Now let us take a complete picture of the primary market, how it functions and different stakeholders. So if you see in nutshell the primary market, these are all the stakeholders within that, be it on the corporates or the companies or the entrepreneurs who is coming for the IPO listing or the IPO offer. There are different stakeholders who get involved and support this activity to get complete, from making offer to the till investor making an offer for the share and all the combinations of these things, and finally making the securities getting listed into the stock exchange. So there is a merchant banker, there is a registrars, there are underwriting brokers, collecting and coordinating bankers, and other agencies including like advertisers, print media, and so on. So the merchant banker, what they do when a company approaches the public for a fund, and the merchant banker manages the process of public issue. They perform in the capacity of issue manager, lead manager, and co-manager. So next to the merchant banker are the registers to the issue, who collect the application money and allocate the share to subscribers. In consultation with the stock exchange, they issue allotment letter, share certificate, and other things within the scheduled prescribed by the regulatory authority. Apart from these, they are also responsible for fulfilling the listing requirements and to see that stock is listed on the stock exchange. So what underwriters do? Underwriters subscribe to a certain amount of capital in the issue. They have to fulfill the gap, if any, due to the failure of a subscription as planned. Brokers place the new issue in the market through their wide network through sub-brokers. Collecting bankers collect the money in the form of cash, check, and other forms for the subscription, and the coordinating bankers correlate the collection information on the subscription and convey the same to underwriter and the merchant banker. A collecting banker may double up accord. Other agencies like print, advertisers, and mailing agencies are also involved in the providing a publicity to the new issue. I am sure you will find this video interesting and you will have a lot of suggestions to make and comments to make. So feel free to suggest and comment, and also support by hitting that like button below and consider subscribing. Now let us understand what is primary market. Primary market is part of the capital market wherein the new securities are sold by the companies for the very first time. Primary market is also called new issue market, that is NIM. It is the market for trading of new securities for the first time. It embraces both initial public offering and further public offering. In the primary market, mobilization of the fund take place through a prospects, right issue, and the private placement of securities. IPO is nothing but initial public offer. It is selling of securities to public in the primary market. It is a process where privately held company will become a publicly traded company with the initial sale of its stock. So company can decide either to sell a part of the ownership or the full ownership to investors. And in the process of IPO, there are two types of price fixing. One is called a fixed price offering, and another one is called book building offering. So in the fixed price of offering, this kind of a IPO company where they set a price for the initial sale of their shares. In the book building process, the company gives a bandwidth on the share prices and the investor will bid in that bandwidth, and finally the interested investors will bid, and the share final price will be decided based on that. So that's how the IPO works in a nutshell. So if you look at it, who are all the people involved in it and how it moves. So there is IPO firm which want to issue a shares and in return want to connect the issue price. For that they will need people like underwriters, the investment banking, which they will work in term with the investors to issue a share and collect the issue price. And the investors are the people who pay the price and buy the issue. And the investor will also work with the share trade on the exchange, and that's how finally the shares get traded in the stock exchange. This is the simple overview of IPO. Now let us see from the investor point of view, what does it mean? Why investors are interested in IPO. So you can see here, the IPO gives a chance for investors to become part of that company's ownership, and he will be entitled for future dividend in that company. And this is the issue which is issued directly by the company, unlike in the secondary market where it is transferred from one investor to another investors. Post allotment, the investor becomes the part owner of that company. When a reputed company announces its IPO, there are highly likely chances that there will be a good appreciation between the price at which the IPO was declared and price at which it get listed. So many such good prospect companies will see initial listing gains, and some of the investors are interested in the listing gains. And if the company prospects is very good, then the future looks bright. There is a good chances that when you get a share allotment in IPO, you would be receiving at a very right price. But recently, like couple of IPO we have seen, be it LIC, be it Zomato, be it Paytm, they all have beaten, although the investor made offering and got the allotment during the listing and post listing trade, they have seen losses. So it's not always right that every IPO will have a listing gains or post listing trades gain will be there. Different company, different valuations will make companies' price look differently, and investors in the primary markets, investors in the secondary markets may have a different view. So this is something an investor need to see and think of and review it. So this is the nutshell why investors are so interested. One is there could be listing gains, if the strong fundamentals of the companies are there, and there is highly likely chances that the company will grow bigger, and it will give very high advantages as well to investors, both in terms of a dividend they earn and also in terms of the price appreciation in the allotted shares. Let us look at entrepreneurs, the way or the options they have in terms of raising funds for their businesses. One is the retained earnings, what they have from the businesses they have done so far. And the second thing is to go for a debt capital, basically going for a loan. And the third one is equity capital, which we are talking now and is more connected with the the primary market or the secondary market or the overall capital market we are talking about. So these are all the three broader classification which are all the options available for be it an entrepreneur or be it a company. They have an option to raise a fund for, be it for paying off their debt, be it for expanding their business and so on. So the retained earnings, it refers to the income remaining after the company's pays off all its expenses and obligations. So that is the retained earnings. And debt capital is nothing but, like I said, it is a fund raised by the company in terms of borrowing money from the lenders, be it the bankers, be it the
some kind of lenders and so on, or also the corporate bonds which they offer with the interest and so on. So these are also a part of debit capitals. And equity capital is one which is interesting to us in this topic. So equity capital is a cash that be it a company rises from initial public offer or the FPO follow-on offers and so on, by issuing new shares to shareholders in the market. And this could be done by selling a common shares or preferred stocks. So this is how they raise equity capital. And from a company's perspective, the IPO helps them identifying their real value, which is decided by the millions of investors once the shares of that particular company is listed into a stock exchange. IPO also provides them a fund for their future growth or for paying their previous borrowings. IPO, or the initial public offer, is a way for a company to raise money from investors for the future projects and get listed into a stock exchange. And eventually the money what they have got from this IPO, it is available for them to use it without having any obligation of returning it or paying it off, because this is a equity inflow to them. That means a corporate may raise a capital in the primary market by way of IPO, right issue, or the private placement. The requirement of the fund in order to finance the business activity motivates the entrepreneur to approach this new issue market, that is IPO. It is the largest source of the fund for long or indefinite maturity for the company, because once the funds comes to company have no obligation to return it back to the investors. The IPO is the route for a company to raise the capital from investor to meet the expenses of its project and to get a global exposure by getting listed into a stock exchange. The funds from IPO is most instances are used for the expansion or the improvement of the company.
Now let us understand what are all the benefits being a public company from the company point of view. So there are several benefits, namely, like it allows them to have a diversified equity base, and it gives them an access to a cheaper capital investment, and it gives exposure and prestige and public image to the company, attracting and retaining the better management and employees through a liquid equity participation, wherein company offers its employees share options, the equity participation and so on, facilitate them in acquisitions, and it creates a multiple financial opportunities, equity, convertible debits, and the cheaper bank loans and so on. So many opportunities come in the way of company. So increased liquidity, equity holders. So these are all the few of the benefits which a public company can harness. I am sure the whole understanding of the capital market, and within the capital market, the primary market, and the understanding of IPO has helped.
Whole narration of the primary market and brief overview about IPO has given you some insight about it. Encourage us by hitting that thumbs up button and consider subscribing. Thank you.